Knowing the ROE for a company for a single year is not very useful to investors because there is nothing to compare it to. However, if investors can compare a company's current year ROE to the same company's ROE from prior years, they should be able to recognize whether the company is becoming more or less efficient. For example, if a company's ROE increased significantly each year for the previous 5 years, it would be an indication that management is becoming more efficient at using investor-provided resources to generate profits. If the trend showed ROE declining each year, it would be an indication that management is becoming less efficient at using investor-provided resources to generate profits. And maybe management should pay the company's earnings out to investors in the form of dividends, because maybe the investors could achieve a better rate of return on their resources without management's help. In addition, investors often compare a company's ROE to the rate of return they believe they can achieve elsewhere, using investments in other companies, investments in bonds, or even investments in bank deposits, etc. When comparing ROEs between companies, investors should be aware that even though two companies might have identical amounts of net income and assets, they could have totally different ROEs. In this situation, the difference in their ROEs would be caused by how their assets were financed. If most of their assets were financed by common shareholders, their ROE will be lower than if most of their assets were funded by debt, i.e. leverage.